it became how fast can you lower your rents to stay occupied.
Yeah,
That's what it became, and it happened much quicker than expected.
sure.
So I mean, I had a gentleman that I was mentoring and learning with back then because back then I'm in my like 30s and I'm still learning, and he was older and had been through some stuff, and he calls up and he says, lower the rents as much as possible, as quick as possible. And it was one of those where you're going, why? It's not, he said, no, we have to fill up. We have to be 100% occupied as we head into this dilemma because it's not going to be over as quickly as we're being told. And, I listened and learned and did what they said. And sure enough, it was the best thing we did. We never missed a distribution to any of our people because we got cash flow up.
Yep.
The hardest thing with this one has been we've been slashing rents pretty good amount, and it still hasn't made it where it fixed it.
Yep. It's a traffic demand side of the equation issue, not
It is,
necessarily a
and it goes to speak to how different either evictions or people or companies are performing evictions. They're allowing a lot longer timeframes to stay in and not going after it as much in order to keep the occupancy looking like it's okay.
yep.
Versus, I think back in 2008, 9, and 10, especially in 2007 and 8, people were good about just getting to their eviction and saying, let's get this done. And it was a quicker process. Dallas County now has a 30-day time frame still because of COVID. And that kills your entire eviction process and it delays everything. And unfortunately, some residents know that. And that's the efforts that they've gone to learn the rules of how not to be evicted have become sophisticatedly much better at how to do that and live in places rent free for it's a year plus. So it's become how can I learn how to avoid being kicked out, and some groups just not wanting to kick people out. We're
Sure.
worried about occupancy
Yep.
number looking bad, and they'd rather be able to talk about their delinquency being really bad than their occupancy looking low.
Nick, is anything cutting in and out? Everything looks good.
Yeah, Michael froze up for a second on my side, but it seems to
Okay.
be good now.
Okay,
Yeah, it's
great.
better. Same here.
Good deal. So everybody's good with everything?
Yes, sir.
Okay. Well, anyone joining on YouTube, welcome. And anyone joining on here on our webinar, welcome. My name's Eddie Austin, and I will be taking us through our slide presentation today. Please stick around to the end. We have a live Q&A to where you can ask all of your questions. I have Brendan here with our investor relations. He's going to have our chat function running and the Q&A. Unfortunately, we will not be monitoring the YouTube function this time on comments. We will catch that up next time. So we're going to go ahead and take off with this. So thank you all for joining. Go ahead and get started. Talk a little bit about my team here. I'm going to let Nick start out. Shane is actually in a conference today, so he's not going to be able to join, but Nick's going to kick us off.
Yeah, thank you, Eddie. Good afternoon. Happy to be here. I'm excited to walk through our Hampshire Fund presentation with everybody. My name is Nick Bouquet, co-founder, principal, COO here at Hampshire Capital. Shane and I founded Hampshire Capital three years ago. We both have long backgrounds in commercial real estate. Shane with over 25 years of experience, and myself with over 15 years of experience, both of us with a deep focus and knowledge and understanding of the residential commercial real estate space. My background's primarily in the apartment business and acquisition renovation of apartments. Shane's background's a bit more diversified, and he's got a background in apartments, specific expertise, knowledge, and experience in land development, construction, and subdivision development.
Thanks, Nick. So Eddie Austin here, emceeing the event. I'm also Vice President of Operations and Construction. I've been in this business a little over 20 years, and I have managed a portfolio of a little over $180 million in construction and investment properties, commercial and residential. And the construction range from nationwide, from housing subdivisions, multifamily, industrial, commercial, ground up development, and industrial solar. Brennan, take us away.
Good thing. Thanks, Eddie. Yeah, my name is Brendan Manning. I'm the VP of Investor Relations here at Hampshire Capital. So what that means is I'm essentially in charge of all investor conversations and some of our offerings that we have for you guys. So any questions that you guys have on our offerings, I can be first point of contact. My background comes from the family office space, kind of working on all strategies throughout the capital stack. If you guys ever need to, get a question answered regarding some of our opportunities, you can email me. I'll put it in the chat here for anyone that's on, but also if you're watching live on YouTube, it's Brendan, BRENDAN at hampshirecap.com.
Yep. Brendan, also, please put your booking link towards the end or at some point in the chat so everybody can book an appointment, anybody that's serious about making the investment. Mo also is actually, unfortunately, sick today. Mo is our land acquisitions expert, and he's been in multifamily and land acquisitions, a little over $100 million in assets in Texas and Florida since 2021. And he's a great guy on our team because he is very in-depth in the detail, system process oriented, and he really understands the end in mind relationships with national home builders, buyers, and land developers. So he's been a great resource on our team. Michael?
Thanks, Eddie. My name is Michael Payne. I'm the Vice President of Asset Management. I've been in the multifamily business mainly for the last 2 decades. With regard to, I've been in operations, budgeting, renovations, investment in private investment of myself, my own funds in multifamily assets. I've had a portfolio of over 7,000 units and $1 billion in value since 2007. From my standpoint, the biggest thing I do is behind the scenes. I'm working with Eddie, I'm working with Nick, I'm working with Brendan to make sure that the properties are meeting the goals that we need to be successful, to make sure that the communication from an investor relations standpoint is on point and is able to help you understand how the properties are performing. And then from working with operations, it's making sure that we're hitting budgets, that we're doing the right things on the properties, and that we're making sure that our residents are treated the best that we can treat them and give them what they need to want to live at our places. So thank you for being here today. We appreciate it.
Thanks, Michael. And for the ones listening, please stick around. I'm telling you, stick around because I'm going to call on Michael to talk about active management and the things that we do. And, a lot of people have been taught to buy properties and acquire them and lean on your property management company to just manage that property for you. Often that's not the case. You really need to be heavy in the details, KPIs, and really pay attention to active management. And we're going to dig into that subject today as well. So please stick around to the end because you won't want to miss out. So what makes Hampshire Capital unique? And it's our integrated operations, our in-house acquisitions, our asset management, our capital management, construction management, and we take an active hands-on approach with all these investments and all these facets of the business. We are extremely hands-on. We are in the nth detail of everything. I say that we're a company that digs into the macroeconomic level, making data-driven decisions. And that's us, everything that we do. We're a neighborhood first, prioritize positive impact on our residents, and we serve as the cornerstone for long-term growth. We really, really care about our neighborhoods. From the residential level to the planning and zoning level, we want to know that we're making a positive impact in every way possible. Another thing is we're a team of industry professionals, dedicated full cycle experience in commercial real estate and alternative assets, investments, investor service, and education. We've been lucky enough to be coined as the gold standard of education when it comes to market analysis, underwriting, and really the investor side of the business and active management. A little bit more about a track record. We have transacted 5,600 units and around $500 million of multifamily and about 320 land development deals equaling 125 million. Between us and the principals, all of us together, we have collectively 70 years of experience in acquiring and renovating, operating multifamily apartment properties and commercial properties and land development. So we put this slide in here because we get this question collectively a lot. Common investing fears. And there's tons of investing fears that we've heard from every side of the spectrum. So we picked 3 different topics, and those 3 topics are what we're going to talk about. So number 1, this is the question I get all the time. I get challenged this in coffee shops and live Q&As, on my Facebook account, on LinkedIn, all the time. Somebody's in conferences. Eddie, I know you're investing in real estate and you seem like you're doing it all the time, but is 2025 the right time to invest in real estate? My answer is always yes, and here's why. If you have a good analyst, good underwriter, good asset manager that can really pay attention to the business plan, if whatever you're looking at, you can underwrite it, you can make a business plan that makes sense, you can mature that asset, then it is worth buying at any type. 2024, 21, 19, all the years. My biggest regret are the properties I did not buy. The ones that I passed by, that I was on the fence on, that I drive around and I see this property and now it's all grown up, it's all developed and everything else. So I was like, man, the guy that developed that, he made a lot of money for him and his family. Wish that would have been me. So I always say that yesterday was the best time to buy real estate or invest in it, or today. That's the best time. Don't wait. These opportunities don't last long. The number 2 thing, my favorite question. I'm a fund manager of this particular fund we're talking about today. Why should I invest in a fund versus individual properties? I may have a biased opinion here, but I believe that I have enough experience with syndications. I am non-biased with my data. And the data is this. If we're going to say, let's go buy 5,000 units here together, and we're going to do that with probably 13, 14 syndications, probably 350 unit property units in mind. That means we got to do 13 or 14 properties 100% right. We got to be perfect on every single one of them. We're going to put all the chips on the table on one single property and one address. Well, let me tell you, things go wrong. They always do. And you don't always have the opportunity to diversify when you have all your chips on the table for one asset. So I highly recommend, if we're going to do the exact same thing, we're going to go buy 5,000 units, do that in 5 separate funds and put all those properties, hopefully more than one asset type, definitely different addresses, in a fund. And if one property doesn't perform as well as we thought, it's okay. You have other properties that's picking it up. Because you got one name in this business, you got one reputation. You never want to ruin that. You never want to lose somebody's principal. And I think one of the quickest ways to lose principal is over leverage and putting all your chips on the table in one asset. So Brendan, I'm going to ask you to take the next question here on, what is these questions you get? So what are those?
Yeah, what question should I ask a fund manager before investing? I think there's a ton. But if I had to, give one that I think everyone should ask, no matter who the sponsorship group is, whether you know them or not, is, are you guys contributing your own capital into the deal? And the reason I say that is because, these decks, these webinars, all the underwriting, all of that is great and it can make sense. But if they're not backing their own deal, that should tell you enough. And I think, us as principals are contributing 5%, $2 million of this fund, of our own capital and our own skin in the game. And that's to showcase our alignment with our LPs, to show you guys that we are involved in this thing too, and we're hand in hand. And I think that goes, to show how much a sponsor really is, invested into their projects because, we don't sleep unless our investors make money, and that's how it should be. And, I think that's always the number one question that you should ask, no matter how much you know the sponsorship group or whatever their track record is. This should always matter.
Absolutely. Thank you. So this is our executive summary here. I'm going to run down the right-hand side of the page first. And it's a $50 million fund. That's our target raise. It's a 10% preferred return, and it's a 20 to 28% average annualized return. And we can hold up to 5 to 7 years. There is no fund level fees, and that is in alignment with our interest with investors in mind. And we'll talk about that more later. First, I want Nick to actually run down through our different asset types in this fund.
Yeah, thank you, Eddie. Glad to. So leveraging our residential commercial background, we really have designed this fund in a very specific way to both balance stable cash flows with additional upside. And so the core of the fund's investments will be focused on multifamily, which provides the stability and the foundation of the fund. We've also then paired that with outdoor hospitality investments, which is luxury high-end RV parks. That is an emerging asset class that offers a lot more cash flow, cash on cash opportunity that helps raise the cash distributions of the fund above what you would typically see in a multifamily deal, call it 5 to 7% conservatively per year once that investment is stabilized. The outdoor hospitality deals are underwriting and generating more like 9 to 12 to 13% cash on cash. And then lastly, we've layered in land development, which we'll dive into more in this presentation, but that is a no cash flow total return strategy that generates tremendous returns in a fairly short window of time that really helps raise the overall returns of the fund as well. So, a lot of pure multifamily funds, you might see average annual returns more in the 14 to 17%. And so we're able to offer a higher level of returns by blending in these other two residential investment opportunities very strategically, very methodically, and we've designed the blend of the fund to help achieve this.
A little bit more on our fund structure here. Nick's going to walk you through all the different types. So we have Class A 1 through 4. So Nick, take it away.
Yeah, sure. So we've set this fund up to have essentially 4 different classes of investors or type of investment that you could choose. And really the difference between the different classes is we're trying to incentivize, or we are incentivizing larger investments will actually get more returns in the fund. So we are compensated in this fund. As Eddie mentioned, this is no fees at the fund level, and we'll get into that more on the next slide. Our only compensation in this fund is performance-based compensation, which is essentially a profit share. After your investment and your preferred return has been hit, then we're getting into what they call the promote or the profit share that the fund managers receive. And you can see it starts at 70-30 at the lowest class, but goes all the way down to 90-10, meaning at the highest class, the LP investors, the investors are getting 90% of the profits, the fund manager is getting 10%, and at the lowest class, the LP investors getting a 70-30, which is much more typical for what you see in typical either syndications or just pure multifamily type promotes and profit sharing. So we wanted to structure something both to give people options and also incentivize people to consider making larger investments. And that's how we get to that range of that 20 to 28% average annualized return, because it really is a range depending on the level of investment that is made.
The fund level fees. So I would really like you guys, anyone watching this, either on the webinar or live on YouTube, this is something I want you to really pay attention to, and take a picture of this slide and take it with you. And I want you to look at the non-performance based fees and the performance based fees. All of these performance based fees are really incentivized. And so these going on the fund level, the fees reduce the net investment returns of the funds and the investors. And these fees are common in this industry and need to be understood before making any fund investments. So just to be clear, Hampshire Capital is not charging any non-performance-based fees in this fund. I want to be clear on that. We are not charging any non-performance-based fees on this fund. The only fees that we would receive is on a property level, and they're based on the performance of the assets. And
Yeah.
go ahead, Nick.
No, you can finish, Eddie. Then I want to add a couple things.
And then another thing is I want you to really think about this. So have you ever heard the words PPM? It stands for Private Placement Memorandum. That is a fund document that you're probably going to sign on any investment. I want you to really look into that and understand the fees and how the compensation structure on any fund or syndication investment. I want you to understand that wording. I want you to pay attention to it. And look, when you're making an investment as an LP, the sponsorship group, the general partnership group, they should be able to clearly answer any questions you have. And if you're making an investment, you should ask these questions. Go ahead, Nick.
Yeah, thank you, Eddie. Just to piggyback on what Eddie has explained on these fund level fees, us excluding the fees, it's not that the fees are bad, they just need to be understood. And I think it's important that investors understand that, while these fees are very commonplace in the industry and in a lot of cases are okay, they do erode your returns and they do reduce your net returns. And so we've really tried to design the fund to be as investor friendly and as investor forward as possible. And that's really why we took out those performance fees and really are just focusing on those, from the Hampshire perspective, our compensation being all based on performance.
Thanks. Go ahead, Nick.
Sure. So Hampshire Capital, we have essentially a 6-point investment framework that we really look at all investments through. And it's really how we think about making investments in the fund, and it really keeps us disciplined. And it starts with a macro-based, data-driven macro-based approach. And really what that means is that we're using data to make investment decisions. We're using data to source deals. None of this is off the cuff. It's all very particular and very precise. And we have a variety of metrics that we use both at the macro, micro, and even the neighborhood level when we're looking at an investment that we take into consideration and that we evaluate, that helps us understand both how to craft the business plan and really what the risk profile is of the investment. And so, it's just keeping it very data focused is, we found to be tremendously beneficial. It's certainly the way of the future, and I think is an absolute core tenet to everything we do here in Hampshire. Next, we have strong partnerships. We've aligned ourselves with best-in-class operators and capital partners. That gives us access to great terms on debt. It gives us access to great vendors. Third is everything we do through the lens of risk mitigation. And what that really boils down to is we're focused on the preservation of capital first and the return or growth of capital second. And so coming back to that heavily data-driven analysis approach, that's part of the overall story and how we achieve the risk mitigation. But that's also achieved, that data-based approach is really and then a lot of the risk mitigation actually happens during the active management process, which is another tenet of ours. So really having that hands-on approach to operations and making sure that we're in the weeds, not just on a monthly or quarterly basis, but literally on a day-by-day basis. We're actively engaging with the investments, we're managing contractors, we're managing the property managers, and we're also continuously looking at data, both our operating data, neighborhood data, market data, really to help triage and understand kind of what we're seeing in the operations and help forecast what we need to do to continue the investment to be on business plan. Next is clear diversification. So that's really the foundation of the fund. Again, blending together cash flow and total return across 3 different residential asset classes. We feel there's tremendous power in that, enhancing returns and reducing risk. And lastly, we take a people first philosophy to really everything that we do here at Hampshire, really focus on the residents. We really do believe that, happy residents in a thriving community really helps create a better investment outcome for the investors. And so we're constantly doing things to engage the residents and really ensure that they're having the best experience possible.
Absolutely. So now let's talk about active management. So I know that Michael today was actually in the field. He went and visited the assets. So Michael and Nick work almost hand in hand on everything that we do with underwriting, understanding data, understand the micro level, the rents, the market rents, and everything. And then Michael really goes in and really dives in to drive that business plan forward. And today he was doing just that. He was actually on property, visiting the asset, and really paying attention to what is actually going on in the neighborhood and understanding that. So, Michael, please share with what you found today and what
Sure.
different things that you looked at.
Well, Eddie, from the standpoint of active management, it's a wide range of what, from an asset manager standpoint, from a diversification of business standpoint, what are we doing to make sure that a property is running in a really good shape? And things that I looked at, for example, like today are, our residents. That's who sends us the funds that we have to disperse out to our investors from both an LP side, a GP side. That's the core. And so it starts there. So what resident events are we doing? How are the residents being treated? Are their work orders being completed? Talking with the maintenance team. So I spoke with one gentleman today. His name is Frank. He's our lead maintenance at a property. And I'm asking him questions. Do you have all the tools that you need? Do you have everything you need to be able to make it where residents can get what they need? It's a myriad of different things. With residents, we hold events at least usually once a week to make sure that they're coming into the office and talking with the office team on site, because we're losing that in our market right now, where AI is driving more things. There's less need to talk to an office team to build relationships. So we're actually working on a way to blend that. How do we use AI, but also not lose our touch with our residents, so that if something is bothering them, they'll come talk to us and they won't just shut us down and not tell us that they're leaving because they're unhappy. I think it comes down to meeting on site and seeing what's happening around the property, walking it, seeing, what's the condition of the roads? How does parking look? All of those different things. And then what you're doing is that you're tying in all of that market data that's going on in that direct sub-market that you're in, along with what is the general market telling us is going on and how does it compare. So you're comparing all of these little different pieces of information that are coming from your on-site team, your residents, what Nick is seeing in the market and buying, and then you're saying, okay, we need to make decisions, and we need to make them very quickly, and we need to make them with the best information we have as a way to move us forward in a positive manner for that property. That's basically what we're doing, and that's how active management plays a role in making sure that the end result for the property is meeting the maximum thing that property can do, based upon the market, the residents, and your teams. And we live it on a daily basis. I love what I do in the sense of getting out there and making sure that things are working like the financials say they are. But is there stuff that we can be doing better, is the question I love to always ask. And it was a great day today. Had some nice weather. We've got some cold weather coming in here in the next little bit. And I love that I was able to get out and see what was happening on site. And I love to be able to say things are quite well at the property and they're moving along nicely.
Thanks, Michael. I got one more thing to challenge you on. I know that we're in the first quarter here and actually the first month of 2025. And towards the end of Q4, you started really paying attention to and working with our property management teams on creating the budgets for 2025. And all of us as managing partners of Hampshire Capital, we signed off on those budgets. Like, you were actively involved with kind of pushing the envelope on different sides of the business when it comes to budget setting. And you also maintain that budget in mind throughout the year. So, quarter over quarter, kind of what we have to hit, to even make that budget work. Because I think it's one thing to set a budget, but it's another thing to actually hit those metrics. So can you touch on that a little bit?
Absolutely. I mean, most of your budget, you kind of have a pretty good idea of what's going to happen year over year. You know what your cost is going to be because it's going to happen every single month. It's a fixed cost. A portion of your budget, though, the main portion of your budget is, what I consider an investment basis. How are you setting up a budget that makes it where you are proactively fixing or doing things ahead of time that are going to actually decrease potentially other parts of the budget? And so it's figuring out what those different things are. How are you addressing HVAC issues during the winter that you could be doing ahead of time so that when you get to the summer, you have less people that are having issues with their HVACs. So it's things like that that you're kind of planning and working on and balancing out to say, where can we invest some money as part of this budget so that it actually lowers other costs. Other parts of the budget are items like taxes. How high are they going to go this year? Or how do we think we're going to be able to negotiate that down? Talking with my third party property management or property tax team to be able to help, give us ideas of what is the market thinking this year that's going to happen. So it's all of those type of events and things. It's talking with a number of different people that are, experts in their portions of that, and then also making a decision and saying, hey, this is where I think we're going and how we need to perform. And then being able to educate people that may not work on this on a daily basis, that are on our team or on other teams that we work with, to say, here's why I feel like that we should be here. These are, once again, it's communication, whether it's with residents, whether it's with your LPs, your GPs. It's making sure that you can deliver news about a budget where it should be. And then how are you performing to that? Sometimes you beat a budget and sometimes you don't. And it's making sure you understand and that others around you understand why you are or you aren't in a very clear manner, and that you're being truthful about what's happening.
Thanks, Michael. Nick, you're the best at market analysis, buddy. So take it away, man. Tell us where we're headed.
Yeah, it's a labor of love.
That's right. That's right.
Yeah, so we're gonna break this down into two pieces. We're gonna run through kind of what we're seeing in multifamily, and then gonna combine land development, RV outdoor hospitality. I'm gonna start with multifamily. It's the largest segment of the fund. And multifamily has had a lot of challenges over the last 12 to 18 months. We still think there are fantastic long-term fundamentals, but that overall asset class, between rising interest rates, huge amounts of supply coming into these markets that is putting downward pressure on rents, increasing occupancy really across A, B, and C type properties. And then, just general economic conditions and quality of renters. It's been a very challenging operating environment. And so that's made it very challenging for us to identify new multifamily opportunities that we think are priced appropriately and that we think also have upside potential and the potential to generate returns for investors. I looked at 250, 300 deals last year, and none of them I felt compelled enough to proceed with or was able to be competitive on. Now that doesn't mean you can't find good deals in this market and they're out there. I'm just saying that it's a time to be tremendously cautious, tremendously picky. And really until we see the data at the macro and micro and even operating levels in our current portfolio start to show us that we've got some tailwinds behind us again, we're going to continue to be cautious. We think that sentiment could start to shift as early as Q2 of this year. We're going to continue to underwrite and look at many deals and continue to track the market data, but it's a time to be cautious and very, very picky in multifamily, which is certainly our approach. And so, whether or not you end up investing with us or you're looking at other multifamily opportunities, I would just caution you to really, really understand the business plan and understand how the sponsor is going to execute against that, because it's a tough time right now in multi. We like to say here we want to be in the right stream at the right time. Multi just isn't quite there yet in our opinion, but we do think it's going to come back in 25. Land development, RV outdoor hospitality, on the other hand, very well positioned in 24, going to continue to be well positioned in 25. It's really where we're focusing a lot of our activities at the moment. Great demand fundamentals, and we've got a land development opportunity that we'll run through with you shortly here. But we've got a land pipeline of about 800 lots of development slated for this year. So we've got a very robust pipeline for land development. We're seeing a ton of opportunity in that space.
Thanks, Nick. So, as Nick stated, we've got the next slide is going to be about the opportunities we have. So, is everybody ready to jump into that slide now and check this all out? We ready to go? All right. So, the first thing is I want to say is what is land? What is land development? And there's land entitlement and there's lot development processes. And I'm going to take you through a very simple scenario on what we do and how we do it, and then the timelines with that, because I think the three things that every investor should be asking is number one, what is the risk? What is the timeline? And how much do I get back? We're going to cover all of that in these slides below. So the first thing is identifying raw land. What is raw land? Raw land is what you see with just fences around it, trees around it. It's just a raw piece of dirt, and there's nobody that lives on it. Maybe there is a small home on it, but it's a lot of land. That's the raw land that we try to identify. And then we take that land and we do what's called an entitlement process. And that's the opportunity to get all the approvals done. This usually takes 6 to 18 months. And that is the highest risk that anybody can take when it comes to to invest in a raw land opportunity. That's the highest risk, because that entitlement risk, that process can be grossly changed. You can find out you have endangered species. You can find out that there's not the amount of density that needs to be on that project to make it make sense. What I mean by density is the amount of homes that can be put on that piece of property. If you're paying $15 million for a piece of property, you hope that you can put at least 300 homes on it. So this particular side of the business here outlined in red, the riskiest profile, that is the fund manager that actually funds the equity to that deal. At this time, we don't actually put that on the actual fund. The next thing is the pre-construction and due diligence phase. That's 60 to 90 days. And that's where we find out that everything has already been approved. Now we're moving into the low risk portion of this. And on the due diligence, we are making sure that we have will serve letters. Will serve letters is I've called a utility company and made sure that they're serving this entire project the way we think about it. Is it based on future revenue, or is there going to be a cost to every home we put in there? What is the lot construction start? And then the finished lot delivery, and then the lots that's sold to the builder. To just give you kind of from the foundation, the finish, from the start to finish of what we're doing here, we are identifying raw land. We are taking that land and we're doing all the site work. We're putting in roads, we're putting in storm drains, water lines, gas lines, electricity. And then we are taking that and we are selling it to a national home builder like D.R. Horton and Lennar. And we already know kind of like that lot cadence. So what they want to pay for these lots and how often they want to take these lots. So we mitigate almost all of the risk. We also mitigate risk by obtaining a forward contract, knowing that they're putting deposits down. They are on the hook. And then that is what we call the horizontal lot development process. And that fund source comes from the HC fund, and that is our low risk. Nick, is there anything you would add to that?
No, I think that covers it great, Eddie. Thank you.
Perfect. The next thing is why land development. There is big upside and it's managed by the right experts. There's really 4 buckets here when it comes to this. And it's the outsized total return. There is definitely high average annualized returns, commonly over 50%. And it is made in a short period of time in the investment world. Most investments you think about are 5 to 7 years. These can happen in 18 to 24 months. We usually try to target 36 months. 36 months for a 50% average annualized return is a very short time frame. And it's an undervalued site in its prime for a transformational. It unlocks outsized returns in comparison to other real estate asset classes. Number 2 is it's really a high barrier to entry. It's a long entitlement process, as stated, usually 9 to 18 months. It's a high soft cost, meaning that soft cost is a lot of money that can come out front. Engineered drawings can cost $250 to $300,000. You have to have civil drawings to even get a site approved. So that means that we as fund managers have to put out $250 to $300,000 depending on the site cost or the site size just to find out that it can be approved. And it's a lot of risk, and we take that risk up front. It takes experience, unique skill set. It's a niche focus. Costs include civil engineering, as stated, site prep, planning, traffic studies, and the land needs to be shovel ready, and all these things have to be done first. The next thing is its favorable fundamentals. The national home builders have a shortage, particularly acute in the Sun Belt region. And this fund is really targeted towards this land entitlement process. And it's up to 25% of the cost of new home development. And it's poorly understood by most developers seeking shovel-ready projects. So in layman's terms, what does that mean? It means we've called up national home builders and we say, where is your process? What do you need to perform? We know that there is a large home shortage all across the United States and mostly in the Sun Belt region. You can think about all the out westerners and everybody else, and even up north, people are giving changes in climates. They want to move to the Sun Belt. So it puts a lot of pressure on these national home builders. When that happens, they have to perform. They need raw land. They need land banking. They need entitled shovel-ready projects. They need projects that have site-ready pads that is ready to go. And that's exactly where we found to find the right stream and following that right stream is because they said this to us. What we need is entitled land with good partners that operate with integrity, that can give us lots on time, that all the entitlement risk is taken care of, and we're willing to partner with you and take down 50 to 100 lots at a time. That's what we need. We jumped in that stream and we took off with it. The last thing is diminished risk profile. Over the last 25 years collectively throughout Hampshire Capital, we have had dozens of projects that went through the entitlement process. Some of these projects were upwards of 60% average annualized returns. That's 60% average annualized returns. It's a lot. Doesn't mean every project's that way, but it can be done. And one of the most difficult is the climate in the country where we've developed before is very hard. We've done a lot of development in the Northeast. Shane has done 25 years in the Northeast. It's extremely hard. So when we realized that we could do it in the hardest climates, we could definitely do it in the Sun Belt climate. And this experience reduces that risk. And honestly, it scares off many developers. It takes benefits to have high total returns. You need an experienced team. And that's what we have. Nick, you want to take us through this slide?
Sure. So this is a land development, lot development opportunity we have actively under contract and are working toward a closing in the next 60 or so days. This is a fund investment opportunity, 318 lot single family home development in Versailles, Kentucky, which is just outside of Lexington, Kentucky. So part of that Lexington MSA. The fund's going to deploy, we're anticipating about 1.3 million into this investment. It should have a 24 to 36 month timeline, where it's going to earn a 30% average annualized return for the fund, which is a 1.6 equity multiple. So just as an example investment, what that translates to is, $200,000 investment would profit $120,000 in 24 to 36 months for a total return of $320,000.
So that's the second thing we talked about. Number one is the risk. Number two is the timeline. We address that timeline here. It's 24 to 36 months. And then how much am I getting back? That's the three things I think every investor needs to look at. And that's what we've outlined here in this slide. A little bit more is risk mitigation. Nick's going to take us through what we've done on this particular project to kind of remove that risk.
Sure, absolutely. So back to our core tenet of risk mitigation. we feel it's important to be transparent and upfront about the risks that we have identified in this, and the risks here really will apply to virtually all land development projects. But it really comes down to three major things. The risks are the sale of the finished lots, counterparty risk, potential site work and lot delivery delays, and construction cost overruns. And how we've mitigated those three risks is really a variety of things, but I'm going to run through some of the key points. On the sale of the finished lots, so on a land development deal, if you don't have a buyer, doesn't matter how great the dirt is, how well you executed on the lot development, you have to have a buyer. A lot of groups do this speculatively, meaning they'll either buy the dirt and title it and hope to sell it, buy the dirt, put in some infrastructure and hope to sell it. As Eddie described earlier, we actually obtained forward purchase contracts from large national and regional home builders that often come with large deposits at closing, anywhere from 10 to 20% of the expected value of the lots that they've agreed to purchase. And so what that really means is that at the closing, when we're investing capital and starting the construction, we actually know who the buyer of these lots is going to be. So that huge risk of who's going to buy the product is really off the table. And then it comes down to, it's more of an execution risk on our part on the construction side of things, making sure we're delivering lots to spec and on time. But the biggest risk is who's going to buy the project. And unlike multifamily, for example, where you buy a property, improve it, and you hope to sell it, we know in land, we're developing land and we know who's going to buy it at closing on day one. And again, with these large builders, these builders are putting these deposits down that are released to us as a source of funds at closing. They're non-refundable. So they already have a huge amount of skin in the game, millions of dollars of skin in the game at closing. And so they're incentivized to stay in as well. We don't rest on that though. We also always have, 2 to 3 backup buyers as well. So when we're looking at a deal on the front end, we're not just taking it to one builder and coming up with business terms. We're actually talking to 3, 4, 5 different builders interested in the market and the project. We're ultimately picking the one with the best terms and the best reputation, but we have backup buyers sort of waiting in the wings if in fact that primary buyer chooses to back out or stop acquisition of the lots. And so we always make sure we've got multiple buyers for these projects. Next, these lots are sold on a phased basis, meaning we're not completing in a 200 lot project. We're not completing all 200 lots and then selling that in one chunk. We're actually buying these in tranches over a period of, 12 to 18, 24 months, depending on what the takedown schedule is. But what that allows us to do is receive revenue throughout the project to properly manage the leverage on the construction debt, pay that down quickly, and begin to return capital to the investors even prior to the completion and sale and last lot being sold. And then delivery schedule. And with the delivery schedule and the construction budget, we're always building in contingencies as well in terms of how we're underwriting the delivery and the revenue side of these. And we always have GMP contracts, guaranteed max price contracts with our site work vendors. We still add additional contingency on top of that to make sure we're covered there from any potential cost overruns or any issues with the contractor that we run into. And then the last major piece is, again, that active management component. We have in-house construction project management as well, which is part of that active component. And so we're not just hiring a contractor and hoping that these lots get developed and everything goes great. We're actually involved through the entire construction process. We're sourcing the contractors, we're managing the bid process, we're selecting the contractors, we're negotiating the contract, and then we're managing them on a weekly basis throughout that, 12 to 18, 24-month process. And so it's really taking the hands-on approach with deep knowledge of the construction process, specifically on this land development and horizontal infrastructure piece, which really helps to mitigate the overall risk of the project.
I'd like to just add one thing there, if I don't mind. But, one of the things, just like what Nick was talking about on the active management side of risk mitigation, just as an example, and we hate the tragedy that's going on out in California with regard to, the events of the fires and such. But from the standpoint of contracts, we've already as a group had a discussion about how does that affect budgets and costs for the future related to construction projects that haven't started yet. And how do we mitigate that? How do we go and purchase things ahead of time before prices might go up due to a rebuild out there? It's that type of thinking that is part of our active management of how we try to go through and stay ahead of if inflation were to kick in on some different things, that we don't let it worry or concern our delivery promises on projects. So I just wanted to throw that in because it is something that it's really important when you're going through risk mitigation on and thinking about projects. You have to really keep your eye on what's happening in the market and where are we at. And it changes all the time on you, and you don't know exactly how it's going to change. And from that standpoint, it's just something to add as a really important factor of how we think constantly, not just setting it up on a piece of paper and saying, "Oh, this is what it's going to do, and this is where it's going to be." We're constantly having to go through those type of things to make sure that we hit our identified scheduled and goals.
Absolutely. And Michael, I think the only way that a team of people learn that type of way to think outside the box is they've been through, a couple different economy contractions. They've been through a couple disasters that were very large disasters that did cause delays, and they did cause building materials to go up, a shortage in materials, and then a shortage in resources and the labor and everything else. And I think that you learn that by just having a well-seasoned team that has a facet of every construction phase, whether you're buying, owning, building, or developing. You have experience in what the delays could impact you and how they would impact you, but most importantly, how they would impact the other people's money that invested with us. So another one we have here, this is a BTR development, build to rent development. That's what BTR stands for. This is 258 units. This project is actually comprised of 70 single family homes that are for rent and then townhomes that are for rent. So this entire project is for built for rent. It is located about 22 miles from the Florida Panhandle, which you would think about Pensacola. So we're 22 miles from there. The fund's investment is 1.6 million, and it's a 36-month timeline, and it's a 25% average annualized return, and it's about 1.7x equity multiple. So we just put an example down here for a $200,000 investment. That's 150,000 in profit, 200,000 invested capital. So your total return. So I get this question sometimes too, Eddie, I don't care about any of those other numbers. What I want to know, if I put a 200 grand in, what do I get back? And then how long? So how long? It's 36 months. And then how much? It's $150,000 in profit. So I think that's pretty good for a 3-year investment. So that's kind of, there you go. We've really looked at the risk, which I'm going to address in the next slide, and Nick's going to take care of that for me. But that's it. So it's 36 months, and if you invest 200,000, now that doesn't mean that the minimum investment of this fund is $200,000. Don't think that. You can invest 100,000. We have accepted 50,000, but we usually set our minimum at $100,000. So we just wanted to give an example on what would it look like if you invested $200,000.
Yeah, and one thing just to add here, Eddie, this is a $57 million project, and 1.6 million in fund investment probably has some, could have some people scratching their heads. This is a co-investment with a large JV equity investor. And so they're actually bringing around 14 million to the project, and our component of the total 15 and a half, $16 million in equity is about 1.6 million.
Absolutely. And you probably wonder how in the world can we actually be on the same field playing with these teams with 1.6 million in the game? Well, it's simply because this particular deal was sourced off market by Mo and Shane. They found it. We entitled it. We got the development order. We put in all of our money first. We took this thing all the way across the timeline. And then we currently own this piece of property outright. So we own it. We've entitled it. We've taken it all the way. And then we handed it to our partnership group that they were very interested in doing the vertical development, because normally that's not something we are involved in, is the vertical development. We absolutely can. We've done it, but we needed some help there, and we can go faster with partners. So we partner with best in class people, and they decided they would bring 14 million to the table, which is $20 million of that $57 million investment. Nick, take it away.
Sure. So again, want to highlight the risks and what we've done to mitigate risk in this development project. So three major risks here: construction cost overruns and schedule delays. You're going to see that theme across really all real estate projects.
Yep.
Absorption and lease up. It's a huge one in a development deal. And then selling the asset at stabilization. Because this is being a 36-month horizon on the investment. The general plan is to build it, stabilize it, and sell the asset. And so we're going to do that over about 36 months. We're able to do the 258 units in that timeline because we're delivering those units in phases, essentially in pods. And so there'll be a period of time during construction where we're actually starting to lease some of the property. And so by the time construction is complete, more than half the units may already be leased up, for example. So on the risk mitigation side, construction costs, really two major things. Again, we've selected a large regional general contractor who has regional expertise and experience. So we've partnered with the right group on this project. We will have a guaranteed max price contract with them. And again, we're budgeting additional contingencies to further mitigate any potential for cost overruns above and beyond what the underwriting has. And this large general contractor also has essentially a series of templated building types. And so, they're not, this isn't something they haven't built before. They've built these building types hundreds and hundreds of times. And so, they have a very specific system, process, and timeline for delivering those buildings, which also helps to further mitigate that schedule and cost overrun risk. They're not building something that some architect designed and their first time building it. They've done this hundreds of times. On absorption and lease up, Crestview is an interesting market in that there are some lease up deals happening now. There's really two main competitors in the market that are currently in lease up. Michael and I have had extensive conversations with several property management firms, and both of those assets are projected to stabilize summer of 25. We won't be delivering our first units until Q3 of 25. So we happen to be hitting the market at a fantastic time. And a big part of absorption and lease up is really, it's less of a demand issue. Crestview's got a very, very strong demand for rental product, but it's really a competition and lease up issue. And so we've got a unique BTR product. This is the only large BTR product coming to this market. And we happen to be hitting that market at a time when most of the existing supply has been absorbed. And so, we're projecting an 18-month lease up there, which we feel is very achievable. And both of our property management companies we've been speaking to about this project also agree with. And next, there's sort of dovetailing on property management. Yeah, we're partnering with best-in-class property managers. These are medium and large size firms with regional and local experience. One of them is already active in the market. The other one is very active in the Panhandle and knows the market well. And back to that hands-on active management component too. Another way we continue to mitigate risk, just being tremendously involved in this project. Like the land development, very involved in the construction as well. Our construction management team will be managing and overseeing both the land development component of it, as well as overseeing that large general contractor. And then lastly, on sale and stabilization, while we're planning to sell this asset at stabilization, we have sized the debt we've put the appropriate type of debt and leverage on this debt. So that in the event that the markets change drastically in 3 years, and maybe it's not a good time to sell the asset, we can convert that loan to we can convert the construction loan to a permanent loan very easily. We can also refinance the loan. And again, that's really the downside scenario on, what happens here and how we're protecting capital in the event that the buy side market has changed, changes negatively over the next 36 months, which, we don't feel like is going to be the case given the kind of the fact that we're in a bit of a lull now in the multifamily. We feel like the fundamentals are going to continue to improve, but we want to make sure we're thinking about, how do we protect that capital in the event that we have a challenge selling this asset at stabilization.
Absolutely. I want to go back 1 minute to, we said that we partner with best in class partners. And throughout this process, we went out and we looked for those best in class vertical development partners. And we looked at what is the price per square foot. And on this particular project, we got that partnership to agree to $106 a square foot to develop that. And even if you were to self-develop, I don't think that you could actually develop for anywhere close to that number. And actually, if you actually take that number, if you look at a 2,500 square foot home that's for sale in Crestview or a new construction, just take that 2,500 square foot home and take the price tag and divide it by the square foot. And that'll tell you how much that is being sold for or what it was developed for. And that kind of tells you that we have a gross margin between what we're actually building this project for and what we're selling it for. So it's time for Q&A. I want to open it up now to anybody that has questions. Again, I apologize. My person that would normally take care of my YouTube comments that would transfer that into this meeting and we'd answer it for you. They are not able to get on right now. So we'll have to pause on the YouTube comments. I will answer those after this event. But anybody that here on the Zoom that Brennan was not able to answer any Q&A, please bring that live to us now. And if not, I want to hear from Michael and Brendan on any additional thoughts.
Yeah, sure, Eddie. One thing that I want to ask Nick, going through it, I thought it might be beneficial for investors to kind of understand just, the current environment that we're in. Nick, you mentioned that you thought, investors, when taking a look at, certain LP positions with other sponsors, they should be weary of multifamily. And you see, outdoor hospitality being much better right now, and it was well positioned in 24, but also 25. What do you think makes it a better, time for outdoor hospitality and things are slowly starting to get better in multifamily? Can you kind of give an example of that to investors and kind of showcase why you think, people should be leery of that?
Sure. So I'll start with why outdoor hospitality, I think is a better opportunity at the moment, or maybe a better opportunity at the moment than multi. I think it comes down to in multifamily, there still is too much capital chasing too few deals. And so I think to find a good deal in multi in this environment is just very challenging. RV park, outdoor hospitality, it's much more of a emerging asset class. And so it's a lot less competition on the buy side. And we've partnered with a best-in-class operator called Beyonder on the RV business. And they have a very sophisticated and diligent way of sourcing off-market RV outdoor hospitality deals. And so I think it really comes down to just the ability to find more investment opportunities in that asset space is really the advantage of that asset at the moment. And I don't, there has been some slowing of the demand there kind of post-COVID, but it hasn't, I think there's probably more of a drastic post-COVID impact on multi than there is on the RV outdoor hospitality business. And so does that answer your question?
Yeah. I think I'd just add one thing, Brendan, and that is the owners right now of your existing multifamily also don't have a belief that their property, even with maybe having some rent reductions and things like that, that they've lost value. And so you have people not wanting to place their units up for sale. And partly it's because they believe over the next 2 years, because of home shortage, because of everything else, that the value of their property could go back up. And to lead into what Nick was saying, there's not much product that's for sale. So it leads into a supply and demand issue, so that the people that are selling are saying, well, if you want to be able to take this on, you're going to have to pay a premium, even though the results right now are the yeah, I'll call it the profit margins on it, just for the price they're wanting, don't make fundamental sense to take that risk level that they're asking you to do right now. So it's it's kind of an interesting, situation. We had a lot of properties come off with variable rate loans. They had rate caps in place coming out of 2021 into this time frame, and they no longer have rate caps that protect them from some of their costs. And they're still trying to figure out their way through the weeds right now of making payments on their loans and still thinking that the value of their properties are at a much higher level than what they right now potentially are. They've come down quite a bit in the last year, value wise, but there's still a good number of owners that just don't want to put it out on the market because they just don't want to think about taking that haircut right now on the value of where it was.
Yeah. Yeah. And just to add to that, there's, on the multi side, a lot of the deals they're transacting, they're, the groups that are buying those properties, and this is a strategy. It's not our strategy. It's not a bad strategy, but they're willing to accept zero or negative leverage, meaning very, very little to almost no cash returns for the next couple of years, in the hopes that after we get through the supply side wave, rents are going to run and cap rates are going to compress and values are going to soar. That again, that's an absolutely acceptable thesis. It's just not our business, because we really want to be able to create returns and yields or much earlier than 2-3 years from now from a cash basis. But that's also part of, what's happening in the market. And again, back to the too many buyers, too few deals, part of me is wondering, our value is still inflated, because as long as people are transacting, you can point to a sales comp and say, hey, that property sold for 150,000 a unit over there, but it doesn't necessarily mean that that it actually is worth that today. So it's a complicated time for sure. There's a lot of moving pieces, and lots of ways to is just lots of things to consider. So, and there's just different strategies. And so for us, our strategy is, buy properties where we have a fairly quick path to, or if we don't have positive leverage or neutral leverage at acquisition, we have a path to get there in year one, where we can begin to make cash distributions that we're comfortable with in terms from a returns perspective.
Absolutely. And another thing to go back to your, kind of flat or negative returns is, we do know this, that there's a lot of institutional level players in the game, capital providers and buyers that used to buy, 400 to 600 unit assets, Blackstone, BlackRock, that bought really nice high end and had a lot of dry powder. We know that they've been raising capital all of this time. They've been divesting assets, but they haven't bought. So we know that they're sitting on tons of dry powder, tons of it. So if that's the case, we know that we're going to be in a pretty hefty race if we want to start purchasing 200 to 400 unit assets and in that Class C, Class B model. And we're going to have to compete with that. And they're okay because they have such a large investor pool. They also get returns like Sovereign Wealth, almost negative returns. So they can be okay with holding assets for 5 to 10 years and it not bother anybody. For us, we try to create value through value add, and we try to appreciate the asset organically. And we also care about our tenants. Like I said, we're a neighborhood first mission. So we're not going to go in and, evict everybody and turn around and raise the rent $200 or $300. It's just not us. And that might be how you create wealth, but that's not how we do it. So just to give a little more color on what Nick's saying is, we know that there's tons of buyers out there still transacting, and it's not essentially going to help. We don't believe, everybody has their opinion, which is not ours. We're still being very protective of everybody, especially our investors. And we believe that the right thing to do is just wait and let the market do what it's going to do. And at that point, when the data speaks to us, we'll start buying multifamily again. Does anybody have any questions at all?
No, Betty, I put my email there on the screen. I don't know if you guys can see that. And just so you know, it's cutting it short with the text, but it's actually Brendan at hampshirecap.com. So just so everyone watching knows.
Thanks, Brendan. Thank you all that's joined. Thank you people on YouTube as well. We'll answer your comments as soon as we can. And thank you so much. And you'll be getting a recording of this also. So thank you all for coming. We appreciate you and have a great day.
Thanks, everyone.